So welcome back to the second part of this video. We'll continue from where we stopped. We were talking about bearish trend, and let's move on. So types of market directions and trend. We just finished talking about the bullish and bearish trend. Now, when we say we have a bullish market, this is a market that tends towards the upward direction, and it is a buyer's market. That is, buyers have more control of the market. More buyers are present in this market. What do you do as a trader? This is a good time to buy. You shouldn't be trading against the market direction. If the buyers are in charge, that's the bulls are in charge of the market, it is a time for you to buy. That means you should be looking out for more buy opportunities. Because if you are going against the market and you are going against those that are in control of that market, you are definitely going to lose your money. Now, bearish market, this is a market that tends towards the downward direction, and it is a seller's market. That is, sellers have more control of this market and more sellers are present in the market. This is a time to look for selling opportunities as a trader. If you go and start looking for buying opportunities in a seller's market, there's a high probability of you losing your money or your trading capital. Now we have what we call a ranging market. This is a market that tends or moves in a sideways direction within a box. It's more like a rectangle. It starts from the base, goes up, come back to that same point, goes back up to the same point. It's moving in a sideways direction. It's not moving upwards like the bullish market. Neither is it moving downwards like a bullish market, but rather it is moving within a box. It is called a ranging market. In this kind of market, we say both buyers and sellers have equal control of the market at specific time intervals. So within the course of this training, I'll be teaching you, or in the advanced class rather, I'll be teaching you how to trade this ranging market so that you can make profit from it. Even when the market is not in a bullish market or bearish market, you can still trade and make money from it. While we have another type of market called the choppy market. In this market, neither buyers nor sellers or both have control of the market. Rather, the market is full of tiny and noisy participants who make little or no move in the market. This kind of market, it is best to avoid it. I'll be showing you other examples later on. But choppy markets, just avoid it completely. When we start when we start dealing with technical analysis in the advanced class, I'll be showing you how this market looks like and how you should stay away from it. So let's move on. Now, they are all called the candlesticks. When you come to trading, you must know your candlesticks very well. It is not the candlestick you use to light your room, but rather these are trading candlesticks. And what are these candlesticks? Candlesticks are tools used in the forex market to gauge the strength of buyers and sellers in the market. So these candlesticks give us ideas of who is in charge of the market at a particular time. Now, this is how a candlestick looks basically. The green one is a bull candle, while the red one is a bear candle. Now, usually the bull candle opens at a low price. Remember, when the bulls are in charge of the market, prices tend to increase. So they open at a low price. This is the opening price. They open at a low price and then they close at a high price. Now we have what we call the highs and the lows. And these highs and the low, they occur as a result of what we call the wick. The wick usually is this tiny or this slim line you see attached to the big body of the candle. This big part of the candle is called the body of the candle, while these small lines or these thin lines are called the wicks or the shadow. This simply means this price actually went to this high point before it came down to this point and then closed. And there's a tendency that maybe when the market opened, it first went to a low point and then came back to the opening price and then went back up and closed high and closed at this high point here. So that is a bull candle. But when you come to the bear candle, usually when bears are in charge of the market tends to go down. That's the prices decrease. So there will be an opening price at a high place and then the closing price will be lower than the opening price. And these weeks, usually when the price opened, the market went high a little bit first before coming back to the opening price and then went down, came to a low price, then went back up a little and closed at this body here. So this is how the candlesticks looks like, and this is the various parts of the candlestick. Now I'll be sharing with you a PDF that will explain to you more about the candlesticks. And in the advanced class and master class, we'll be looking at how these candlesticks can be used to trade the forex market profitably. Now, there are various types of analysis. We have what we call the sentimental analysis, technical analysis, fundamental analysis. Now, the sentimental analysis here, each trader has his own opinion of why the market is acting the way it is doing. In sentimental analysis, is more of your own sentiment as a trader. When you look at the forex chart, do you see, you might say, okay, based on what I'm seeing, this market is selling, or based on what I'm seeing, this market is buying. It is all your sentiment as a trader. Then when you come to technical analysis, it has to do with you studying the price movement. It has to do with you using indicators, charts, candlesticks, or lines to study the movement of the market. This one is more technical. Why? Because you're using various assets to analyze a particular market to know what's actually happening in the market. Now, when you come to fundamental analysis, it deals with trading the market based on news and events of a country and its economy or currency strength. When, for instance, let's say the president of Nigeria wakes up and says something about maybe he wakes up and says something about the economy, and that statement he makes affects the currency, the strength of the economy or the strength of the currency. So there are people who wait to hear news about certain economies or certain countries, and then they trade the currencies of those countries based on the news that has been released about that country. Now, you can get news, forex trading news from this website called www.forexfactory.com. You can visit it. You see how various news about currencies. I'll show you how to read, how to understand and read and understand the news, the forex news from this website. So there's actually a special type of news that's released every first Friday of the month, and it is called the NFP. NFP simply means non-farm payroll. It is usually a news released on the United States dollar. It's only on the United States dollar, and this news is usually about the employment rate in the United States of America. It is usually called the king of all news releases because a lot of money is usually made every first Friday of the month by forex traders. If you're able to trade this non-farm payroll, you can trade it once and that is all you are made for the month. You don't need to trade again. That's if you learn how to trade this NFP, because there's a lot of money that is brought on the table when it is time for NFP. Most traders wait, there are traders that just wait for NFP alone and trade only NFP. Now, there are what we call trading orders, forms of trading orders. Now, there are basically three of them. There's what we call the market execution, that's instant market execution. There's what we call the stop orders and the limit orders. Now, for the instant market execution, it simply implies that you are buying or selling a particular currency pair at the current market price. That means the current market price is what you are buying that currency pair for. Now, when you go to stop orders, you are not buying at the current market price when it comes to stop orders. Why? Because these stop orders, you are buying at a particular future price. That means it, like what we said here, we said these are not instantaneous orders because they are set to take place at a future price. That means you anticipate the market to behave in a certain way at a future price, so you place a stop order. There are usually two types. There's what we call the buy stop and the sell stop. For the buy stop, for example, if a currency pair is presently at $50, a buy stop order will be that the broker should execute the trade for you when the market buys to a certain point, for example $70. This means that, okay, the current price is $50, but you want to place a buy stop at $70. That means when the market reaches $70, you want it to continue buying. That means you want to enter a buy at that point. You believe that, okay, the market will continue buying to maybe $100, $150 and above. So you place a buy stop order. That means you are not entering the market currently, but you are going to enter it at a higher price. Now, this order is taken with the hope that the market will continue buying. On the other hand, a sell stop order will be that the broker will execute the trade for you when the market sells to a certain point. For example, you believe that the current market price is $50, but the market is going to drop to $45, and when it reaches $45, it's still going to drop more to maybe $30 and below. So you tell the broker that, okay, when the market reaches $45, please enter a sell for me, a sell order for me, or a sell stop order. So this order is taken with the hope that the market will continue selling. And it is important to know that a stop order is set ahead of the current market price. While limit orders, these are not instantaneous orders because they are set to take place at a reversal or turning point in the market. So let's say the current market price is $50. You believe that when the market reaches a certain point, it will reverse and go in the opposite direction. So it is also divided into two. There's what we call the buy limit and the sell limit. For example, if a currency pair is presently at $50, a buy limit order will be that the broker should execute the trade for you when the market sells to a certain point at $44. Okay, if the price now is 50, the current market price is $50, and the price, you believe that the price will reduce to $44 before it will continue buying, maybe to now from that $44 it will start buying and go to $50, $70, $100 and above. So you are not going to enter a buy at the current market, but you want to wait for it to reverse, let it retrace down, that's it should go down to $44, then you enter a buy. You want to start from the scratch when it is at the cheapest point, and then you buy and continue from there. So that is what a limit order is, a buy limit order. It means you believe that this $44 will be a turning point and is about to turn back to the opposite direction and start buying. So you place a buy limit order at this $44 price, so that when the market moves from $50 and reduces to $44, a buy order will be placed for you, and then you start buying from that point to a higher point. Now, similarly, a sell limit order will be that the broker should execute a trade for you when the market buys to a certain point. Maybe, for instance, the current market price is $50, and then you now tell the broker that, okay, when this market buys and reaches $65, I would like you to place a sell for me, because from that $65, I believe the market will turn and sell back to a lower price. So this is what we call limit orders, both sell limit and buy limit. Now, as a summary, the stop orders, usually the stop order is set ahead of the current market price. Don't forget this, you set your stop order ahead of the current market price. While for limit orders, you set the order behind the current market price. Now, this is just a chart showing you an example of a bullish trend. Remember, I told you the bullish trend, that means the bulls are in charge of the market. You see the market is going upwards. You see the direction of the arrow, the market is going upward. Now, when the market is going upward, we have what we call the highs and the lows. The high simply means the highest point the market reached before it reduced a little and then continue moving back high. Now, for instance, look at this market. It started moving up from this point. This was the lowest point it was before, and then it started going up, and reached this point. It formed the high, and then it came down a little of sellers came in. These red candles are the sellers, the blue ones are the buyers. So the buyers pushed the market to this price, then sellers came in a little bit. Sellers failed to push the market back down to where it started buying, so they just came in a little, and then buyers resumed their movement again. So you can see this point here is called a high. It is higher than this previous one, so it is a higher high, and this is a low price because this is where the sellers came in briefly, and then the buyers came in and pushed up to a higher price again. So it formed a higher high again, higher than the previous high. Do you get? Now, sellers still came in a little, tried to push the market down, but buyers resumed again and pushed it back further up. So it formed another higher high. But mind you, this was the lowest point the sellers came to initially. But when buyers pushed it up and sellers came back again, they tried to push it back, but they could not push it back to the previous low point. So they formed a higher low. That means a low point that is higher than the previous lower point. Then from this lower point here, buyers came and pushed it to form another higher high, and then sellers came down, but they could not push it to the previous lower point. So this low here is a higher low. It is a low that is higher than the previous low. So the same thing, that is how the market keeps going until sellers are able to push it back down completely. Now, if you come to these other charts here, you see that the market is going downwards. The direction is going downwards. Why? Because sellers are in charge of this market. Look at it, you see that there are more red candles compared to the other green candles, which signify the buyers here. Now, if you observe the same way we had higher highs and higher lows, here we are going to have highs that are lower than the previous high. For instance, this is the highest point this market was here, but sellers pushed it down and then buyers tried to come back up to push it back up, but they failed to reach this point again. They formed a high that is lower than the previous high. So it is called a lower high. It is a high point, yes, but it is lower than the previous high. So it is called a lower high. And then sellers came back and pushed the market down to go lower than where it was before. So this is called a lower low. A lower low. The price is at a lower low compared to the previous low price. Then buyers try to push it back up again, but they fail to form a higher high, or they fail to reach the previous high. So it is called a lower high. You can see it is decreasing. The highs are going downwards. So it is lower high, while the lows are getting deeper. So it is lower low. So this is how you know a bearish trend and a bullish trend. In the bullish trend, you see the market forming higher highs and higher lows. While in the bearish trend, when the bears, the sellers are in charge, you see the market forming lower highs and lower lows because the price is decreasing. Now, we've talked about candlesticks. There are other types of charts that you can see. You can see the line chart, you can also see the bar chart. But mostly traders use the candlestick chart because the candlestick charts give you more information about what is happening in the market. Now, that is all for the Financial Trading 101 video training, and we'll call it a day here with this video training. I'll give you indicator setups as a document you can go through and set it up on your chart and use it to start trading. So if you have not gotten the advanced trading course, try to get it because there's more of the analysis that will be done there. We'll be going deeper into Forex trading in that video. Thank you for watching to the end of this video. And if you have any questions, don't forget to drop your questions and they'll be answered.